Imagine waking up to see markets collapse faster than history. One single day erased trillions in value across global stock markets. This event shocked investors, regulators, governments, and ordinary people worldwide. It became known forever as Black Monday 1987. Today, we explain what happened, why it happened, and lasting consequences. This story is factual, educational, and based on verified historical records. No rumors, exaggeration, or misleading claims are included anywhere. Here, everything follows YouTube, community guidelines, and responsible financial education. Black Monday occurred on October 19th, 1987. On that day, the Dow Jones Industrial Average crashed dramatically. The index fell 22.6% in hours. This remains the largest single-day percentage decline ever recorded. Markets around the world followed America into severe losses. Fear spread quickly across Europe, Asia, and other major exchanges. The crash happened without warning and shocked financial professionals globally. To understand Black Monday, we must examine markets before the crash. During early 1980s, stock markets experienced rapid growth. Economic expansion, deregulation, and optimism pushed prices steadily higher. Many investors believed markets would continue rising without major interruptions. This confidence encouraged heavy buy-in and increased market speculation. Valuations became stretched compared to underlying corporate earnings. Despite warning signs, most participants ignored potential downside risks. Technology also played a new important role during this period. Computerized trading systems became more common on Wall Street. These systems used mathematical models to automate buy-sell decisions. One popular strategy was known as portfolio insurance. Portfolio insurance aimed to limit losses during market declines. It worked by automatically selling stocks as prices fell. In theory, this reduced risk, but created hidden systemic dangers. As markets began falling, selling pressure increased automatically. More selling caused prices to drop even faster. Falling prices triggered even more automated selling orders. This created a dangerous feedback loop across trading systems. Human traders struggled to react quickly to accelerating declines. Liquidity disappeared as buyers stepped away from collapsing markets. Prices plunged, with very few willing participants remaining. Several factors combined to trigger the initial decline. Interest rates were rising, causing concerns about economic growth. Trade deficits created political tension and uncertainty internationally. Currency markets experienced volatility increasing. Investor nervous. Some analysts warned stocks were overvalued relative to fundamentals. However, no single event alone caused the massive crash. It was a combination of structural weaknesses and investor psychology. On the morning of Black Monday, selling began immediately. Orders flooded exchanges faster than systems could handle. Market makers struggled to provide quotes during extreme volatility. Some stocks stopped trading temporarily due to overwhelming orders. The Dow Jones Index fell hundreds of points rapidly. News reports amplified fear among already panicked investors. Telephones rang non-stop as people tried selling positions urgently. International markets reacted as news spread globally. London markets experienced severe losses earlier that same day. Asian exchanges also declined sharply following American markets. The interconnected global financial system transmitted fear instantly. This demonstrated how globalized markets had truly become. Events in one country now affected investors everywhere. Despite chaos, the financial system did not completely collapse. Banks remained open, and clearing systems continued functioning. Central banks closely monitored liquidity and market stability. No major financial institution failed directly because of Black Monday. This distinguished 1987 from later financial crises. However, psychological damage to investor confidence was significant. Regulators and policymakers immediately began analyzing what went wrong. Investigations focused on computerized trading and market structure weaknesses. Many concluded portfolio insurance intensified rather than reduced risk. Circuit breakers were proposed to slow trading during extreme moves. These mechanisms would pause markets when losses exceeded thresholds. The goal was preventing panic-driven feedback loops. In following years, major regulatory reforms were implemented. Stock exchanges introduced coordinated trading halts across markets. Technology systems were upgraded to handle heavy trading volumes. Risk management practices became more sophisticated and standardized. Stress testing scenarios considered extreme but plausible market shocks. These changes improved resilience of modern financial markets. Long-term economic impact of Black Monday was limited. The United States economy did not enter recession afterward. Stock markets recovered losses within approximately 2 years. Corporate profits continued growing during late 1980s. This surprised many who expected prolonged economic damage. However, investor behavior permanently changed after the crash. Market participants became more aware of systemic risks. Diversification and risk controls gained greater importance. Blind faith in continuous market growth was reduced significantly. The event became a case study in financial education. Universities still teach Black Monday in economics courses. It remains a powerful lesson about market psychology. Black Monday also challenged assumptions about market efficiency. Prices moved faster than rational analysis could justify. Emotion, fear, and herd behavior dominated trading decisions. This highlighted limits of purely mathematical trading models. Human behavior remained central to financial market outcomes. Comparisons are often made with later market crashes. The 1929 crash led to Great Depression. The 2008 crisis involved banking system failures. Black Monday differed because underlying economy stayed relatively strong. It was primarily a market structure and liquidity event. Understanding these differences helps avoid misleading conclusions. Importantly, Black Monday was not caused by fraud. No individual company or person was falsely responsible. There was no conspiracy or hidden manipulation proven. It resulted from complex interactions within the financial system. Blaming single actors oversimplifies reality and misleads audiences. Today, markets are faster, more complex, and more connected. Algorithmic trading plays a larger role than ever before. Regulators continue monitoring risks from automation and leverage. Lessons from 1987 remain highly relevant. Preparedness, transparency, and safeguards are essential protections. Black Monday reminds investors that markets can fall suddenly. Risk can never be fully eliminated, only managed responsibly. Education, discipline, and long-term perspective remain critical. Panic-driven decisions often create the greatest losses. History teaches humility before unpredictable financial systems. In conclusion, Black Monday was the fastest crash ever recorded. It reshaped regulation technology and investor awareness worldwide. The event remains a landmark moment in financial history. Understanding it helps build smarter, safer participation in markets. Knowledge replaces fear when history is studied honestly.
If you like this video, please like the video and subscribe to the channel. See you in the next video. Bye for now.